Slow money.
It's time now for, you guessed it, slow money. Tonight we are asking the traders to give us a name or names that at today's bear market levels are worth buying now and holding for the next 5 years.
I wonder what Tim's going to say.
I have no idea.
I'm excited to hear.
All right.
I mean, people have been hanging on. I think the ratings just for waiting for this segment. And again, it's a new segment, folks. So
Slow money.
It's exciting.
Yes.
Slow money.
Thankfully, it goes slowly.
So let's continue the lift story.
Just a thumbnail because we got, you know.
Let's give some ground to some other people. But the reasons for the next 5 years are the reasons why you own Lyft, because it is a global leader in transportation as a service. It's not just rideshare. It's bikes, it's scooters, it's all kinds of things, the partnerships that they have. The driver issues and the ASPs are two things I am not worried about. The compounded annual growth rate of probably 25% over these next 5 years and the profitability that's, basically the operational leverage in this model. This is a stock. Doesn't matter that it's down 80% from its highs. It matters that this is a company that's well positioned for the future. And I think a lot of the noise out of COVID will be in the rear view mirror.
Wow.
Right.
Yeah, that's what I did.
Down whatever percentage from highs is meaningless for this particular exercise. It is where it is here and where it will be in 5 years. So, Karen, what's your slow money play?
My slow money play is actually an ETF. It's the XLV, which, the top of the show guy was sort of in agreement with that. I mean, a lot of reasons. The valuation, I think, is attractive right here. The balance sheets are in great shape. You have a sort of non-discretionary demand for the products. And for a lot of them, great dividend yield. So I think this is a good place to hide out. I'm here.
This is a Karen name, but I actually didn't read the instructions on the email, so I didn't realize it was like today. I actually think you have to mind the gap. I just think they're going to have better opportunities to buy any of these things, okay? And I'm going to use Google here, Alphabet, okay? And this is one that on current estimates, they're expected to be up, okay? Earnings this year are expected to be down. So expectations have already come down. Next year, expected to be 12% earnings growth, 13% sales growth, 68% gross margins. They have 10% of their market cap in cash, all the above. Great. Here's the thing, guys. There's going to be a gap. There's got to be a realization that the 2023 numbers are not going to be what consensus is right now. And you're going to have an opportunity to buy a stock like this better. And when you get that gap, it's not going to be a one-quarter thing. It's going to take 2 quarters to work themselves out. So the stock trading at 97, the consensus targets on this thing is 143. There's 48 buys and 3 holds and no sells. Sentiment hasn't shifted yet. So you're going to have an opportunity to buy a Google, and then you buy it in the 80s or something like that, and you'll hold it for 5 years.
When I was in college, I took a final exam my senior year.
And you didn't read the instructions?
And I didn't read the instructions.
And what happened?
And I was so excited when I just read the first part, and I know this. And I started to frantically write. And I handed it in. And then the professor called me in later, said, you didn't read the instructions. I said, but yeah, I did such a great job. That's what Dan just did. That's exactly what Dan just did. I didn't get a good grade. You want to grade Dan quickly or no? Or you just want to go?
A C.
I agree with that, by the way. I wish I got a C in that class. With that said, I say this all the time. Gandhi could be president and defense spending will go higher in this country. Lockheed Martin trading at 14 times next year's numbers with a 24% growth rate. That's where you want to be in this game.